I get this question a lot. Should I set up an LLC or an S corporation for my medical or dental practice? And if you've searched online, you've seen the same generic advice recycled over and over. Advice written for general business owners, not for physicians and dentists. So here's a problem. That generic advice is like using Robitussin to treat every medical condition, like Chris Rock once said in his comedy special. Jokes aside, the framework might look similar on the surface, but the details that actually matter are completely different. I'm Dr. Taxtor, and I help physicians and dentists with tax planning and practice structuring. By end of this video, you'll understand how these entities actually work in your world, when an S corporation creates real tax savings, and when it probably won't. So let's start with the question most people skip. So when people say LLC or S corporation, they're essentially comparing two different things. An LLC is a legal entity, an S corporation is a tax election. Comparing them directly is like asking whether a diagnosis is better than a treatment plan. They're not in the same category. One leads to another. Here's how it actually works. An LLC creates a legal separation between you and your business. If the practice has a contract dispute or vendor claim, that structure can help protect your personal asset. But here's what physicians and dentists need to understand right away. An LLC does not protect you from your own malpractice. If a patient sues you for something you did clinically, you're personally responsible. No LLC changes that. That protection comes from your malpractice coverage, not your entity type. Now, on the tax side, an LLC is flexible. By default, single owner LLC is taxed as a sole proprietorship, and a multi owner LLC is taxed as a partnership. But an LLC can also elect to be taxed as an S corporation or a C corporation. So an LLC is like a morphine. It can be used to treat pain or shortness of breath or sometimes sleep disturbance by pain. One tool, multiple applications. So the real question isn't LLC or S corporation. It is, what legal entity are you required to use and how should it be taxed? So for most physicians and dentists, the answer ends up being both. A professional legal entity that elects S corporation tax treatment, which brings me to the issue most online advice completely ignores for doctors. So if you practice in California like me or many other states, there's a legal layer that comes before any tax election. In California, a standard LLC cannot provide professional medical services. Physicians typically must practice through a professional medical corporation, dentists through a professional dental corporation. And all these entities have specific professional ownership requirements. Think of it like hospital credentialing. You don't get to choose whether to be credentialed. It is required before you can practice, right? Similarly, your state may dictate your legal entity before you ever decide how it is taxed. The good news is that professional corporation can still elect S corporation tax treatment with the IRS. So you can still access those tax benefits. The legal structure and the tax election just happen at separate steps. The bottom line, if you're in California, your first conversation is with the attorney who understands professional practice entities, not a generic business formation website. Then comes the tax strategy. Let's talk about the tax benefit everybody's promoting. When a business is taxed as a sole proprietorship or partnership, the net profit is generally subject to self employment tax, which includes Social Security and Medicare tax. For high income earners, that's a significant number. With an S corporation, you split the income into two buckets. You pay yourself a reasonable salary, which is subject to payroll taxes, and the remaining profits come out as distributions, which are generally not subject to those same employment taxes. So think of it like this: in a sole proprietorship, every dollar of profit gets the same tax treatment. In an S corporation, you're doing a differential diagnosis on your income, separating what's compensation for your services from what's a return on your practice as a business. The saving only exists in that gap. And here's where physicians and dentists often get bad advice. If your reasonable compensation is roughly equal to your total net profit, there's no gap and no meaningful S corporation savings. Consider a solo clinician whose practice earns $250,000 and whose clinical work is a sole driver of that revenue. What would a comparably trained physician in that market earn? Probably 230 or 250,000. There's no room for a meaningful distribution layer. Adding S corporation status in that scenario is like ordering $1 million workup for a patient with an itchy rash. More costs, more complexity, no additional benefit. Now, contrast that with the physician who owns an established practice with associate physicians, nurse practitioners, or support staff. That practice generates $1 million in net profit. Reasonable compensation for the owner's combined clinical and management duties might be $350,000. The remaining $650,000 in distribution, that's where the tax savings actually live. The key question is there a real spread between reasonable compensation and total business profit? For mostly solo clinician producers, that spread is often smaller than people expect. For owners of practices with real leverage, it can be substantial. If you're going into practice with two or more physicians or dentists, stop here. Because the S corporation advice breaks down fast in multi-owner setting. S corporations require distributions to be made pro-rata, which is strictly proportional to ownership. So if two physicians each own 50%, distributions are split 50-50. Very little wiggle room there. Imagine two surgeons sharing a practice. One, the rainmaker surgeon, operates 4 days a week, take extra call, and drives 70% of collection. The other works 2 days, fewer procedures, lower volume. A strict S corporation says they each get the same distribution per ownership share. That's like a surgical team splitting the attending fee equally, regardless of who performed the operation. It creates resentment. It doesn't reflect economic reality, right? A partnership structure can fix this. Partnerships allow what are called special allocations. You can distribute profits based on actual production, collection, call coverage, and any other agreed formula that reflects how the practice actually works. So, partnership also offers better flexibility when practice carries debt, including build out loans, equipment financing, real estate. Partners often factor that debt into their tax basis in ways S corporation shareholders cannot, which matters when losses are involved. For many group practices, the cleanest structure is a partnership of individual professional corporations, a partnership entity in which each physician's or dentist's own professional corporation participates as an owner. That preserves flexibility at the group level while still allowing individual tax planning at the professional corporation level. More complex? Yes. But for multi owner practices with different productivity levels, it's usually the better answer. So, a few important details before you call your accountant and ask for an S election. So, number one, payroll is mandatory. If you elect S corporation status and you're working in the practice, you must run payroll. Real payroll with regular withholding, quarterly filings, a W 2 at year end. You cannot just take whatever distribution you want. This is one of the fastest ways to attract IRS scrutiny. Use a payroll provider. Number two, reasonable compensation must be defensible. The IRS expects your salary to reflect what the market will pay for your role based on your specialty, your duties, your market. For physicians and dentists, that number is often significant. If your compensation is set artificially low to maximize distributions, the IRS can reclassify those distributions as wages and hit you with back taxes and penalties and interest. Document how you determine your salary. Number three, health insurance requires careful handling. If you own more than 2% of the S corporation, health insurance premiums generally must be included in your W 2. If this isn't handled correctly, you can lose the deduction. This is a detail many S corporation owners miss entirely. Number four, California adds a layer. A California S corporation generally pays a 1.5% franchise tax on net income. That's not a deal breaker, but it needs to be factored into the math, not ignored. And wherever you practice, check your state local tax rules as well. If you're a physician or dentist ready to think about this seriously, here's a sequence. First, confirm what legal entity your state requires for your profession. In California, that usually means a professional corporation, not a standard LLC. Get this right before anything else. Second, model your actual numbers. What is your projected net profit? What would be your reasonable compensation for your specific role? Is the gap between those numbers large enough to justify the added compliance costs? Number three, if the numbers support it, makes a S corporation election correctly and on time. And miss or defective election is far more expensive to fix than to prevent. Fourth, set up payroll before taking your first distribution. Fifth, stay current on annual compliance, including federal and state tax filings, payroll filings, corporate formalities, and clean bookkeeping. The tax strategy only works if compliance hold up. Here's a bottom line. For physicians and dentists, the LLC versus S Corp question is not the same conversation you hear in general business content. Your legal structure may be dictated by state professional practice rule. So your S Corp saving may be limited if your income is largely compensation for your own clinical work. And if you're building a group practice, a partnership structure often gives you far more flexibility than a single S corporation ever will. Don't start with the tax election. Start with your legal requirements, your actual practice economics, and the realities of your profession. If you want a deeper dive on any of these topics, reasonable compensation benchmarks for your specialty, or how to structure a partnership of professional corporations, or California specific compliance, leave a comment. If this helped clarify something you've been confused about, subscribe. I'll keep breaking down the tax issues that actually matter to physicians and dentists. I'm Dr. Taxtor. I'll see you in the next one.